Alex Straton, Morgan Stanley analyst, joins us now. What do you expect as far as promotions, Alex? And does that mean margins are at risk?
Sure. So look, what I would kick it off with is the fourth quarter and the holiday setup for retailers is really challenging this year for a few reasons. We've got the hardest sales and profitability compares of the year. We've got a compressed calendar, the shortest number of days between Black Friday and Christmas. And we have one less week for a lot of these retailers that report on a retail calendar. So what it means and what we're braced for is potentially higher promotional and discounting activity to effectively compete. It's going to be a really competitive backdrop. And this is arguably where we're the most kind of uncertain or nervous heading into holiday season, because we've also seen some signs of excess inventory, a recent uptick in activity, and then also this competitive setup that I just went through.
So with that setup, it feels like you just really have to be nailing it when it comes to giving the consumer what they want and picking winners and losers in this retail environment. Who do you like?
Yeah, that's a really key theme for us. So I'm happy you hit on it, is that we're entering this winners, losers type of world that really we started to see begin in the second quarter, where sales and profitability performance began to widen across the group. We think that only gets bigger in the third quarter and the fourth quarter. So within that type of framework, there's a few things we're looking for from like a scorecard type of perspective. First is, where are your inventory levels? We want lean. What kind of third quarter momentum do you have? We want strong. And then where's the fourth quarter bar? We want low. And a few names that hit that are TJ Maxx, On Running, and then also Gap. Those are the three that we think could prove real holiday leaders this year.
The Gap turnaround, how well appreciated is it by the street at this point? Because we've seen a big gain so far this year already.
Sure. I mean, look, this brand reinvigoration strategy that the new management team is pursuing is clearly bearing fruit, but it also comes on the back of really deep work the prior management team did from a cost savings perspective. I think some of it is priced in, but not all of it. I think what's holding that stock back right now is actually the Old Navy division, over 50% of revenue. And it did, have a bit of a challenging quarter on weather headwinds. But otherwise, Gap, Athleta, Banana, you couldn't ask really for better trends in those businesses. So I think that's the final piece of the puzzle that might be a little bit difficult to shine through in this competitive fourth quarter backdrop. But they did say there were some green shoots quarter to date. So we're hopeful that continues. And at that point, I think, as people get more convicted around leaders in the holiday season, it's always tough with these more fashion-oriented names. It's possible that stock, it tests $30 or so and it's really working. So we've got some room to go here.
Well, they have Zach Posen also as the creative director, and that has definitely, I think, turned around the look and style. He's so talented. Alex, what about Bath and Body Works? Let's just go there, because today it's having another monster day. Is this a turnaround story? Did expectations get too low? And is there still opportunity here?
Sure. So on Bath and Body Works, something that we've been focused on all year is this revenue inflection. Now, the context on that stock is that it's been sort of a reversion play, whereby their candles and sanitizers category was over-earned so severely during COVID, and it's had to come down ever since. And so that core has been a drag on the business. What we learned today is that core finally returned to growth, and they're expecting ongoing growth into the fourth quarter. That's arguably been the key catalyst for the stock for some time now. So I think it's a little bit of that catalyst coming to fruition, and also a bit of offside positioning, because people were particularly bearish as that it was seeming like it wasn't going to come to fruition. So I think that was a positive surprise this morning.
Yeah, you like it, right? Although I think have a lower price target than where it's trading now.
Yeah, they've caught up. Look, I think, what we were not convinced on heading into this print was that revenue inflection would be durable. I think I have a slightly different view exiting today, just in terms of some of the commentary they gave on the core versus the adjacencies. But otherwise, this is a business that when you compare it to the rest of apparel, it's more CPG, right? So it's kind of a starlet compared to the rest of my coverage, in that it's in a higher growth, higher margin category. Importantly, has 85% domestic sourcing, which is really important as you think about tariff risk heading into next year. And now that we have this potential, return to growth back in sight, I think you see people willing to underwrite the story more so. It's been one people have wanted to get more positive on because of all those factors relative to the rest of retail and apparel as a category. So, it doesn't surprise me the move today.